Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Chinese recovery seems to be the theme of the day with a recovery in the PMI numbers. China's strong manufacturing activity data, along with a higher than expected German inflation data, led to some sell off in USD as euro and some commodity currencies strengthened. While for INR, we are seeing some strength as it sort of breaks from the tight range it had been trading for the past few weeks. JK, good morning. I think a lot of our listeners are interested to know whether this strength in rupee is sustainable. What are your thoughts?
Good morning. Importantly, rupee has moved through successive supports at 82.60 and 82.50 with ease in the last couple of sessions, driven by few bunched up flows and buying not so intense. For a change, we have also seen rupee reacting to moves in the dollar index and Asian currencies, which is quite a change from what we have observed in the last couple of months when rupee was decoupled. That indicates markets positioning importers adequately hedged compared with exporters, and possible change in view from traders after seeing consistency of central bank intervention at the highs, and hence tending to go with the flows. At least in the current month, in the lead up to the financial year, and we see a slight shift in bias on the rupee playing out, with market possibly less prepared for a relatively stronger rupee. Technically, break and close below 82.60 is what we have seen. Could see more follow through on the downside to test 82 eventually by the end of the month. In fact, on the economy side, India's PMI once again came quite good at 55.3 versus 55.4 in January, with input costs in the manufacturing industry is increasing due to the inflation. But we have also seen sobering news from CMI, which noted the unemployment rate increasing to 7.45% from 7.14. But on the good news side, Moody's Investor Services raised India's economic growth estimate in 2023 to 5.5 from 4.8. On the global markets, inflation is really making stark headlines once again, following France and Spain seeing higher inflation. Germany again announced much higher inflation, headline coming at 9.3 year on year versus 9% expected. On services side was very inflationary for Germany, and preliminary reading on both month on month and year on year inflation have been much higher than expected. And in Europe, largest economy, this is concerning and possibly leading to today's flash Eurozone economy inflation number being higher than 8.2 that the market is discounting. Now, German 10-year yields have hit a 14-year high, and the 2-year, which were deep in negative territory just for a perspective a year ago when it was at minus 0.82, is now at a new 14-year high. And now we really have to see where the Eurozone inflation prints. And the US session saw inflation fears intensify, with the monthly ISM survey showing prices paid component surging to 51.3 versus 46.5 forecast, as demand clearly outpaced the supplies. And this was the first time the prices paid printed above 50 mark since September last. So while the ISM number itself was quite in line with the expectation, the prices paid component evoked more response from the market. And once again, it was a 10-year yield on the US breaching the 4% mark. In fact, is right now trading at 4.02. And this was last seen in October 2022. But it was a 2-year that hit a new cycle high at 4.9040, last seen in July 2007. The cycle peak in 2006 was 5.2920, with official Fed funds rate peak at 5.25% at that time. Just a history here that rates held at 5.25 from 2006 till September 2007. And in under 15 months, rates were down to 0.25%. Of course, the big slide was triggered by global financial crisis. Economy watchers as well as bond traders would be hoping that we will have rates drop without a similar crisis. Now, Fed funds features show traders are more. There are more traders looking at the 5.75 terminal rate, although the majority is still with 5.5%. And also ECB pricing has lifted by almost 150 basis points, so now probably nearing 4.5% terminal rate. In fact, the yields are moving in both Germany and US in tandem. That's the reason why dollar has actually been slightly weaker, more against the euro than against other currencies. From the economics point of view, China PMIs were, as you said, the strongest since 2012. Manufacturing Purchasing Managers Index shot up to 52.6 from 50.1 in January, exceeding the analyst forecast of 50.5. And European and Eurozone, European and UK PMI were broadly in line with expectations, but were still under 50 mark, which is still in a contraction territory. ISM from US improved over previous month, again a touch less than forecast. So it was China's number that restored risk sentiment and helped maintain it in the US session as well. On the Fed speaker side, Kashkari, a known hawk, and Bostic both preferred hikes in steps of 0.25% despite the recent spike up in inflation. Stocks held up despite higher inflation and surging needs. It was mainly due to Chinese data bouncing strongly, erasing the negativity out of inflation numbers. It was a day of soft dollar, with February gains being slowly eroded. China data and then Asian currencies strengthening. The German yields helping the euro. Also, UK Bailey cautioning against market, implying that Bank of England was finished with the rate hikes. So all in all, the US spike in yields is not really helping the dollar so much, because everyone else is also seeing higher rates in their economy. After all, however, yen stood out once again. In fact, weakened more as Japanese officials continue to harp on maintaining a easy money policy, and the carry trade, I am told, is once again back in vogue. Now, market waits for more clues from US economy, particularly the non-farm payrolls, for which we'll have to wait for a little over a week. Finally, big sentiment on the geopolitics. China showed support for Russia earlier by sending its top diplomat to Moscow last week, has issued a call for peace, although it has been met with skepticism in Washington. And also, US is lobbying with allies on possible sanctions against China if they provide Russia with military aid in Ukraine. So these have been keeping the investors on the edge as well. Yeah. So a lot to chew about. So on the inflation and geopolitics. So as we move into the end of the week, thank you.
Thank you, JK, and a lot of developments. And just to give you a quick summary, we are seeing some strength in INR driven by flows, along with some coupling with the fall in dollar index in the Asian currencies. Of course, break of the technical level of 8260 was significant. Indian PMI number was better than expected, but unemployment rate has risen as well, which is a cause of concern. On the global markets front, we are seeing a resurge in inflation from France, Spain, and Germany, which have posted higher inflation. And also German yields have hit a new cycle high, and now the market will be keenly looking at the Eurozone inflation numbers. While the yields in US have also been moving up, US 10-year is trading above 4%, while there has also been a sharp rise in US 2-year yields. Terminal rate expectations for Euro and Eurozone, for US and Eurozone both have started going up. So what kind of change in narrative this will lead to, only time will tell. It's important to remember that FX markets are relative. Who comes out worse will drive the relative strength. That's it for today. Keep managing your risk. Thank you so much for listening.